The $2 trillion pot of cheap money known as reverse repo is draining at lightning speed. Will this leave Wall Street scrounging through the couch cushions to buy federal deficits? So what is reverse repo and why does it matter? In short, reverse repo is a way for banks and hedge funds to deposit cash at the Fed just like you would deposit money at your local bank. So those banks and hedge funds are essentially lending the money to the Fed. Why do they do this? Because unlike a regular bank, the Fed cannot default or collapse. After all, they have a giant money printer. Plus, of course, the Fed pays them, which is great fun for Wall Street. So the Fed prints the money, the hedge funds turn around and lend it back to the Fed and collect interest. Meanwhile, for the Fed, it is a great way to mop up extra money so it doesn't bleed out to inflation or push bonds to negative rates. The problem is that if financials are getting worried about bank failures, it can lead to sudden jumps in reverse repo and money parked at the Fed. That's exactly what happened in 2021 as the Fed reimposed bank requirements suspended for COVID, then started paying interest to soak up some of the trillions they had printed. The actual bank collapses came later. All this made reverse repo soar, going from several $1 million to $20 billion by March of 2021. $170 billion by April, $500 billion by May, all the way up to $2.5 trillion by January of this year. At which point there was literally more parked in reverse repos than all of the physical currency in the country. All of that changed dramatically starting in June of this year as reverse repo use plunged even faster than it had risen. At this point, down $1.2 trillion in just 6 months to roughly over $900 billion. So what changed? Simple. There's a boatload more government debt sloshing around soaking up that cash. Meanwhile, rates are rising on treasuries as markets get more nervous about the federal government than they do about bank runs. In numbers over the past year, the Fed has rolled off $1.2 trillion in treasuries, meaning it let them mature without replacing them. That's equivalent to selling them. Meanwhile, the federal government is flooding out deficits almost twice as big as last year. We're close to $2 trillion now per year. All while loan demand dries up as companies get choked thanks to the Fed's panicked rate hikes. So the most recent Sleuth survey shows both tightening loan standards and slack demand for loans. So banks don't want to lend, companies don't want to borrow. In short, the government is spending even more as the real economy slows, and both are sucking out the easy money. So what's next? Brought to you by Unchained. What's next is like so much of what the Fed does today. $2.5 trillion in reverse repos was an experiment. We have never been here before. In fact, there's speculation whether the new normal requires a large reverse repo balance, perhaps $750 billion, lest we get a liquidity crunch as excess cash runs out. Of course, it's only speculation since even Fed officials admit they have no idea how much is needed. Note that a treasury auction nearly failed last week, suggesting cash is scarce despite over $900 billion still parked in reverse repo. As always, the Fed is driving at night as fast as possible with no headlights. Nobody knows where the wall is on reverse repo, but at the current pace, we could be there by March. Okay, we'll be watching. See you next time.